Hi, I'm John Nicholas. Bitcoin is in the headlines as its price has rocketed up and is near an all-time high. Early adopters have had extraordinary gains. Mainstream investors are thinking of joining the cryptocurrency craze too and are adding cryptocurrencies to their investment portfolios. Great wealth creation, however, attracts attention, not only from the news media and excited investors, but also from the IRS. The IRS wants the taxes due on recognized gains on cryptocurrency transactions. This video covers tax issues related to Bitcoin. Cryptocurrencies like Bitcoin are taxed, you ask? Cryptocurrencies aren't really currencies. Although Bitcoin is a store of value and a medium of exchange to buy things, the IRS categorizes Bitcoin as property. To the IRS, transactions in virtual currencies like Bitcoin are taxable, just like transactions in any other property or capital asset such as stock. Therefore, a sale of Bitcoin may result in tax liability and have to be reported on your tax return. This would be if a capital gain or loss is created, the difference between the value of the Bitcoin when acquired and the value of the Bitcoin when sold. Your cost basis in Bitcoin is the amount you spent to acquire it, including fees, commissions, and other acquisition costs. Like property, your adjusted basis is the basis increased by certain expenditures and decreased by certain deductions or credits. In addition, the IRS considers spending Bitcoin on purchases to be similar to selling it. The IRS states that the use of virtual currencies to pay for goods or services generally has tax consequences that could result in tax liability. You have similar issues in exchanging one cryptocurrency for another, say Bitcoin for Ether. You only owe capital gains taxes on Bitcoin when gains are realized. Also, similar to buying and selling stock, if you owned Bitcoin for more than a year, you pay long-term capital gains on any profits upon sale, and can take a loss if you recognize the loss upon sale. If you owned Bitcoin for less than 12 months, then you pay short-term gains at your ordinary income tax rate, or recognize a short-term loss. For example, if you purchased one Bitcoin for $7,000 last April, and then used the same coin, now worth $55,000, to pay for a Tesla, you would have to report capital gains on the transaction. In this case, the exchange created a $48,000 capital gain, the difference between the $7,000 purchase price of your Bitcoin and the $55,000 Bitcoin used as payment for the car. Some might ask, with regard to transactions using Bitcoin, how will the IRS know? Isn't blockchain underlying cryptocurrencies opaque and untraceable? Crypto blockchain transactions are often made anonymously. That's the appeal to certain people of using cryptocurrencies, hiding their transactions. But the US government and other governments around the world are working to track these transactions. What government would allow billions of dollars worth of transactions to go unsupervised and untaxed? In March 2020, the IRS's Office of Fraud Enforcement announced Operation Hidden Treasure. This program directs agents trained in cryptocurrency and asset tracking to focus on taxpayers who omit reportable cryptocurrency transactions from their tax returns. Tax evading cryptocurrency owners are the IRS's targets. The IRS is also leaning heavily on Bitcoin exchanges, such as Coinbase, to provide details on their underlying wallet holders and their Bitcoin transactions. Coinbase, for example, now reports crypto activity meeting certain criteria to the IRS. Additionally, the Financial Crimes Enforcement Network announced it intends to have cryptocurrencies in foreign accounts be reportable. Individuals typically must report any financial interests outside the country that exceeds $10,000. With this change, cryptocurrencies like Bitcoin will count as financial interests that need to be reported. In late 2020, the IRS put on the front page of its 1040 tax form this question: at any time during 2020, did you receive, sell, send, exchange, or otherwise acquire any financial interest in any virtual currency? This yes/no question gets you, the taxpayer, on record about the existence of your cryptocurrency holdings. This is a document you sign under the threat of perjury. There are a number of nuances regarding your acquisition of Bitcoin and how you use it, which will affect what taxes you pay. Since cryptocurrency is newer than stock, its ownership is not as straightforward with regard to reporting. If you hold your Bitcoin at a third party, such as Coinbase, you likely are not receiving a 1099 form that will solve your Bitcoin tax reporting issues, as you would a 1099 from a brokerage firm holding your stocks and bonds. Whether you hold Bitcoin at an exchange or in your own wallet, it's up to you, therefore, to inform the IRS of any gains and losses associated with your Bitcoin taxable events. In addition, state tax laws in general are more varied and unsettled in their treatment of cryptocurrencies than federal guidance. You cannot just follow the federal model and expect all to be well with regard to your state tax compliance. Keeping detailed records of your Bitcoin transactions, then, is indispensable. You should document any receipts, sales, exchanges, or other dispositions of Bitcoin, and the fair market value at the time of the transactions. Yes, it's a tedious task, but you want to avoid spending even more time and money later dealing with a tax compliance problem with the IRS. A positive for Bitcoin is that, like appreciated securities, it can be gifted to a charitable organization and enable the donor to potentially benefit from avoiding capital gains taxes and obtaining a charitable donation deduction. There are a number of record-keeping, valuation, and IRS filing requirements and qualifications related to charitable tax deductions for cryptocurrencies. In addition, for a charity, there are different requirements when accepting Bitcoin donations, such as whether the donations of cryptocurrency are accepted directly into the charity's own account or indirectly, such as via a donor-advised fund. It's best for an investor or charitable organization to work closely with their tax professional on these issues. Thank you for watching.